Good morning, everyone. Thank you for joining us for the webinar today. First and foremost, we hope you and your families, colleagues, and friends are safe and healthy. Just a few housekeeping items before we get started. We will be recording this webinar. It will be emailed to you by tomorrow, July 2nd. You can also visit schgroup.com and we'll have it posted on our website. We will take questions at the end of the webinar. We'll answer them at the end of the webinar, but if you have any questions along the way, you're welcome to submit them using the questions tab. Some of the information in today's webinar is very fluid, particularly as it relates to the PPP and Cares Act programs. The content and advice we are presenting today is our interpretation of what is available at the moment. All businesses should continue to work closely with their banks, their attorneys, and their accountants. Before I kick it over to Pam, a little bit about SC&H Group. We are a management consulting and accounting firm that works with organizations from startup to publicly traded at the intersection of finance, accounting, and technology. We help our clients navigate everything from valuation to corporate tax and audit services, mergers and acquisitions, technology advisory, and outsourced accounting. We want to make sure that organizations are covered through each stage of their growth, because as one challenge is solved, another opportunity is around the corner. And we want to be a partner that is well-versed in your business and available when and how you need us. Our webinar today will be led by Pam Sheldon, principal in our accounting solutions practice, and Leanna Steele, a senior in our accounting solutions practice. And now I will turn it over to Pam, who will kick things off for us.
Good morning. Thanks for joining us today. As Colin mentioned, I lead the accounting solutions practice here at SC&H, where we have a team of CPAs and experienced bookkeepers providing outsourced CFO, controller, and bookkeeper level services for small to mid-sized companies, usually at a fraction of the cost of hiring those positions full-time. We use all cloud-based technologies, enabling efficient handling of our clients' accounting processes. A little bit about my background. I started my career with KPMG in North Carolina, and I've been a CFO for the past 20 years, working for small to mid-sized companies, both independently owned and private equity owned, in the logistics space and the ed tech space. I've sat through countless board meetings and discussed cash flow forecasts at length. I'm excited to talk with you today about cash flow. It's one of my favorite topics. Every business is different and in a different cash position. I hope that you can take away a few nuggets of info that helps you navigate through our current climate. This just summarizes our accounting solutions practice that I covered recently. Here's the agenda for today: the importance of good data, burn rate, cash flow, managing costs, navigating the PPP, and some grants. So let's get started. The importance of good data. So I'm going to talk about cash is king. A wise man once told me this, and I never really appreciated it until I had no cash. And then I realized that if you have cash, you get to make decisions. And if you don't, then you're at the mercy of someone else. So I highly encourage you to think about the cash is king philosophy and make decisions based on that. So let's talk about cash flow. So cash flow is the difference between your cash flow coming in and your cash flow going out. Cash collected from customers is a source of cash flow coming in, grants, investor funds, sale of equipment, and tax refunds. Some examples of cash flow going out is your payroll, rent, vendors, equipment, inventory, interest, and maybe some other purchases. So your cash flow is the difference between your cash coming in and your cash going out. If your cash is going out is greater than your cash coming in, then you're burning cash. So let's talk a little bit about your cash burn rate. It's the rate at which a new company is spending its venture capital to finance overhead before generating positive cash flow from operations. It's a measure of your negative cash flow, and it's typically discussed in terms of a monthly burn rate. This is the focus for new companies and startups, because if you have overhead and you may be pre-revenue, you're going to be burning money, and it's a hot topic for investors. And they want to know how fast you're going to burn through their money. Investors want to see that you understand this So you need to ensure that you can discuss it easily and that you kind of have that information at your fingertips. It shows that you own it, and it shows that you're focused on it and that you care about it. Tied with your burn rate is your runway. And this is the amount of time the company has before it runs out of money. So for example, let's say you had $600,000 in the bank and your burn rate is $100,000 a month. Then you have about 6 months of a runway before you run out. If you're beyond like 3 years, I think you're kind of good and you don't need to focus on it every day. Anything less than 2 to 3 years of a runway, you need to plan to address what's going to happen at the end of the runway. At the end of the runway, you need a trigger event. So either you're going to have customers and enough revenue to cover your overhead, or you're going to need to raise another round. Some investors might put milestones in place in order to receive the next round. So your goal here is to slow the burn and extend your runway. So if you look at our earlier example, if you're able to slow your monthly burn rate from 100,000 down to 50,000, then your runway increases from 6 months to 12 months. And you can see just having that additional time horizon gives you more options in running your business and getting it off the ground. Your goal is to achieve liftoff, right? Your goal is to get customers generating some revenue to help cover your costs. So an important data point is your historical cash flow. So it's a really good starting point. You need to have a really good understanding of what you have historically spent. So, take a look at the rearview mirror and see what you've spent. You need to look at your past 6 to 18 months to kind of get a good trend of what have you been spending money on. You need to identify any unusual activity and kind of pull that out. So once you kind of understand the historical view, then you can start to project the future. So the first thing you need to do is kind of determine your cadence. Do you want to project it on a daily basis, a weekly basis, or a monthly basis? And your runway is going to determine that. So if your runway is like 2 months or less, you need to be looking at a weekly cash flow forecast to understand exactly when you're going to run out of money. If you're looking at a 6-month horizon, then you're probably going to be looking at it maybe weekly. And if you're 6 months or beyond, then you can look at a monthly cash flow forecast. You need a reliable method in order to project. And so that's why I wanted to start with your historical data and your trended data. That's a really good basis. But then you need to add your future projections and any growth factors, anything unusual that you know about. The numbers that you put in your forecast need to match your story. So if you're telling investors that you plan to have revenue in 6 months, then your cash flow forecast needs to match that. It doesn't have to be exact, and I'll talk about this a little bit later. Your revenue forecasts tend to be optimistic, so your cash flow forecast, you might just want to put a factor on that and bring those numbers down just a little bit. You want to make sure that you provide room for error for unknown circumstances and play the what if game. What if in January somebody had said, how would a worldwide pandemic impact your forecast? You'd be a hero right now. I don't think anybody has that crystal ball. But make sure you play the what if game. If you know that you're a person that wears kind of rosy glasses and you look optimistic, find somebody who isn't so rosy and play the what if game with them. It'll really help you build in the cushion that you need for your cash flow forecast, because the last thing you want to happen is to run out of runway. If you say you've got 6 months of a runway, you need to have 6 months of a runway. Nothing's worse than something coming up and you only have 4 months of a runway. You're going to be scrambling. So let's talk a little bit about how to manage our costs and how to control them. So your cash flow, we talked about it's a measure of your cash coming in, your cash going out. So we want to speed up our cash flow coming in and we want to slow down our cash flow going out. Sounds really simple, right? And it is, but the devil's in the details, and I'm going to get into some details here, and you must focus on it. Someone in your organization needs to focus on it because you can easily lose sight of it. If the entire team is focused on product development or sales or strategy building, you need somebody who's looking at it with you, whether it's your accountant or somebody, and just make sure that you look at every decision through the cash prism. So let's talk about ways that we can kind of speed up our cash flow coming in. If you have revenue from customers, you can consider offering discounts for early payments or bulk purchases. try to get payment up front, collect before shipment or before service delivery. Align your business processes and customer agreements around the cash is king philosophy. If you're pre-revenue, then consider structuring your customer cycle for cash collection up front. The sooner you train your customers on your expectations, the easier it will be to get a cash collection up front. Work with your bank, see if you qualify for an SBA loan, look at equipment financing, make sure that you're aligned with a bank that matches your business model. So if you're a young and nimble company, look for a bank that matches that philosophy. There's a lot of banks out there that work with venture-backed businesses that maybe traditional banks would not provide credit to. And then kind of last resort would be your investors. Can they fund earlier than expected? Can they give you more than expected? It's worth pursuing, right? You might not be able to go that, but it's definitely a source of cash. So let's look at cash flow going out and ways to control that. So I separate cash flow going out into two categories, fixed and variable. And I'm not using it in the typical cost accounting framework that you usually understand with fixed versus variable. To me, it's fixed is kind of the non-controllable, whereas variable is your controllable. So let's talk about that a little bit. So your payroll costs are fixed. Once you hire somebody and you've got a payroll cycle that's every 2 weeks or once a month, you want to make sure that you have enough cash to fund that, right? You can't say, oh yeah, we can't make payroll, we'll pay you next month. That just doesn't work. So it's kind of a non-controllable fixed cost. Same with benefits. Once you lock in and you're providing health benefits, you need to pay your health insurance provider, every 30 days, or they're going to cut off your benefits. Rent, landlord's going to enact some heavy late fees if you don't pay on time. Utilities, they'll just cut you off. So again, you need to pay them. Employee reimbursement. Once you set your payment cycle, they're going to expect to be paid on a regular basis. Business insurance is another one that's critical for the business and not one that you can usually push out. If you try to push it out, they'll turn off your insurance and then you have a gap in coverage and you have to get it restored, and it's a little bit of a headache. So just from experience, I know that's not one you can really push. Some controllable costs or more kind of your non-critical vendors, maybe consultants, attorneys, you might be able to push your payments out 90 days. Just a quick comment on pushing out 90 plus days. It could impact your credit. Maybe you care about that, maybe you don't. And you're also going to see a buildup in accounts payable on your balance sheet. If you're somebody that bothers you having that, then you might not want to push as much as you can. If it doesn't bother you, great. It's really kind of a personal preference, but know that you still have that liability to those vendors. You've used that service. To me, it's a great way to turn your vendors into creditors. So I'm going to talk a little bit about the fixed non-controllable costs and ways that we can actually move them on that spectrum to where they're a little more controllable. You're still going to have that fixed payment cycle, but maybe we can reduce the cost that we're incurring here. So those are things that I want to cover today. One of the biggest items is payroll for most companies. So I wanted to spend a little bit of time talking about payroll because it's usually your largest expenditure. So, one thing to consider is layoffs. That's difficult to do, but if you're in a cash strapped situation, you certainly need to take a look at that and consider layoffs. You can consider some part-time work or work share arrangements. You can control the overtime. You can say overtime is not approved unless, by the executive of the business. Use of independent contractors or temp staffing is also a good way because independent contractors, you can turn them on and off. It's a lot easier to turn that switch than it is with full-time employees or part-time employees. You've got more of a commitment there. If you're starting to hire employees, these are things you want to consider. Can you start with independent contractors, or can you start with part-time or work share arrangements? It's just something to consider. You want to identify your critical employees and make sure that they understand that they're safe, that they understand why you're having to make these cash flow decisions, and you want to make sure that they stick with you. Because this will create an unstable work environment, and you don't want to lose your good employees. Some other things to consider is some deferred comp arrangements. Maybe at the executive level, they're willing to take no salary or a lower than market rate salary in exchange for equity or stock options. That's a good way to defer your cash flow there. And again, just make sure you understand the impact to your employees. Payroll tax, always remit your payroll taxes on time. Don't mess with it. You don't want to land in jail. A little bit later in the webinar, we're going to talk about how to take advantage of some payroll tax credits and deferrals that are available right now that are completely legit. So stay tuned for that. The other area that goes with payroll is your benefits. And this is an area that there's a lot of room to really kind of control your costs here and make sure that you only provide benefits on a basis that matches your cash flow, right? So health insurance is pretty common that when you hire somebody, they expect to be offered a health insurance plan. But I really encourage you to work with a health insurance broker who can advise you how to structure a good plan for your employees with minimal cost to the company. There are 100 different ways to provide, and you can provide a good plan, and most of the cost is borne by the employees instead of the company. And it's something that you can share with your employees that you'll improve the benefits over time as you get to cash flow profitability. But I really encourage you to work with a health insurance broker. They are paid by the insurance company, so it's no cost to you, and they can be really creative. I've had a lot of success working with some really good health insurance brokers. The one that goes right with that is what I'll call kind of voluntary benefits, and I might not be using the right phrase, but it's the dental, it's the vision, short-term disability, long-term disabilities. Those, you can offer them, but they don't need to be company paid. They can be entirely employee paid. And at least you're offering the benefit. You have the option to buy health, dental insurance and vision insurance and short-term disability. Bonus plans are another one that you can structure the payment schedule. So I encourage you, if you can, I wouldn't have bonus payments due if you're not cash flow positive. You might have to do that in order to retain some top executives, but I would certainly make them annual payments, versus quarterly or monthly payments. Commission plans is another one that you can, you can design this so that you can structure your payments. You certainly should use the cash is king philosophy here, and do not pay commissions until your customers pay you. That's a good cash is king philosophy there. You can also structure it so that maybe they're only paid on an annual basis or maybe quarterly. The more that you can stretch that out, the more it's going to help you with your runway. 401k plans is another one that you can offer a plan to your employees, but you don't have to match it. So it's a no cost benefit option, which is fantastic when you're burning through cash. I would highly encourage you to not add a match component until you're cash flow positive. You can always, add benefits later. And that's my key reminder here. It's always easier to add or increase your benefits once you're cash flow positive than it is to eliminate or reduce a benefit once it's already been granted. I've unfortunately experienced having to do that multiple times, and it's really demoralizing to the workforce to have a benefit taken away. So just be really judicious before you offer those benefits. So next I'm going to slide and talk a little bit about vendors and how we can kind of manage and control some of the fixed costs that we've got coming out of our cash flow. So my big button here is ask, right? Always ask for extended payment terms, doesn't hurt to ask, right? And you'll find out some vendors will have flexibility with their cash flow. Not all. Some vendors might be in the same boat that you're in and they need cash up front. But a lot of vendors might not be super critical, and they might be willing to, in order to lock you into maybe a longer term commitment, they might be willing to give you extended payment terms, which will help you with your cash flow management. So I highly encourage you to negotiate the timing of payments with your vendors. So let's talk about rent. So if you're in an incubator space, that's awesome. Stick with it as long as you possibly can. If you are currently renting space, consider the need for that, especially during this time. I think a lot of businesses are figuring out that their employees can work remotely and they don't need to pay for rent. It's a very expensive overhead cost. But you might already be in a rent space. you might have twice as much space now as what you need. So I would seriously consider, downsizing, understand the terms of your lease agreement and when it renews. Many do require a notice period, and if you don't give them that notice period, it will automatically renew. So just make sure you grab that lease and take a look at it. You can consider subleasing. It might be a tough market right now to sublease, but this is where a good commercial real estate broker can help you. They're worth their weight in gold if you need to manage your rent space. Business insurance is another one that's one of those fixed costs, but it's definitely, it's critical. You need to have business insurance, but there's a lot of room to look at your coverage options. So again, if you have a really good business insurance agent, they can help you explore the options that are available to you. They can explain what's common for your size business and in your industry and make recommendations there. A lot of times you could consider increasing your deductible, and that will reduce your premiums. And then most business insurance plans will offer extended payment terms. Highly advised, take advantage of that if you're in a cash flow situation. Utilities, I don't have much to offer there. There's usually very little flexibility, and they're critical. You don't want the lights to be turned off in your building, so you need to pay your electric bill. Internet service provider, there's usually not a lot of room to negotiate there. They're going to want their payment. Trust me, I know. We didn't pay our internet provider, and they cut off our internet service, and that's usually critical to any business. So those. Usually they're on the smaller side of your expenses. Just make sure you pay those timely. So then you've got vendors that you purchase equipment and inventory for. These are going to be on your balance sheet, right? So they're not showing up in your income statement, but it's still cash flow going out. Equipment purchases, look to finance it through your bank or other sources. Vendor financing, negotiate extended payment plans. Even your smaller equipment like laptops, monitors, and office furniture. A couple of years ago, I found a great deal with Dell. So instead of spending $1,500 to $2,000 to buy a laptop for all of your employees, they had a monthly plan where you could pay, I think it was $50 a month for 3 years. And at the end of 3 years, they'd give you a new laptop. So that's a fantastic way to actually extend your cash flow and extend your runway. Just defer it as much as you can. On the inventory side, that's if you're gonna get into inventory, if your business requires inventory, and that's not your core competency, I would really encourage you to outsource your inventory. I've worked with a company that, when I joined them, they had probably 5 years worth of inventory on hand. Over a 12 to 18 month period, we got it down to a just-in-time inventory. It takes a lot of focus and attention to understand lead times, minimum order quantities, your forecasting. There's a little bit of a science to that, but it can certainly save you a lot of cash. If you can get somebody else to maintain your inventory and control that and manage it, and you just pay as you need it, that's certainly the most efficient way to go about doing that. So some other expenses that you can look to control is employee reimbursement. So make sure you have a really good expense reimbursement policy. That's really important. And if you have one, look at it. Can you tighten it up? Limit the amount of your meal reimbursement, your hotel, your airfare. Keep in mind that, especially if you're a young company and maybe it's just you and a couple other employees, you might think, oh, everybody here is using good judgment and what they should spend. But as you grow and as you add employees, you might end up hiring somebody who's worked for a very large company and they're used to having a really large expense reimbursement budget. So it's a good idea to go ahead and put policies in place because somebody might come on board and they're used to, when they fly overseas, they're used to being able to fly first class. Well, you don't want to be on the hook for a $10,000 airfare. So just make sure you put restrictions in there. You can always grant exceptions to it, but start with a policy that really caps that. It's a good practice to get into early on. So bank fees is another one that you can take a look at. What are you paying for? Is it all necessary? You can ask for a treasury management review of your account with your banker. And I encourage you to do that. It's interesting to learn. They've got lots of bells and whistles there and ways to protect your money. Just make sure that it's all necessary and that you're okay with the cost that you're paying for that. Technology services, certainly cloud-based hosted environments are more cash flow favorable than having an in-house server room with, dedicated temperature controlled room with servers that are very expensive. Cloud-based hosted environments is kind of the way to go. Our entire team is working on cloud-based technologies, and when we had to start working remotely, we just didn't miss a beat. So I highly encourage you to consider using, cloud-based and hosted environments for your business. Copiers and scanners, again, if you're in an office, just limit. Everybody doesn't need a printer in their office. You can get one that everybody can use. Just don't overcommit there. They're hard to get out of, the leases. So let's take a look at the spending approval policy. Who can authorize spend within your company? Be aware of that and understand it, because once you've committed, it's really hard to then adjust the payments. It's hard to come in later and go, oh, we want to pay over 12 months. Can you give us, extended payment terms? So you just want to make sure that whoever's committing the company to that spend understands your cash flow management strategy. You need to balance authority and empowerment with cash management. And if you're authority and empowerment kind of comes more when you're cash flow positive, and then you want to start to delegate some of those spending limits and authorities. I'd be really hard pressed if you're in a cash burn situation to delegate too much of that. You can also set approval limits and tie it to budget, but I just caution you to be careful with spending based on a budget, because budgets need to live and breathe. They're going to change, circumstances change. And just because you had an initial approval to spend $100,000 on a piece of equipment when the budget was prepared, 3 months later, situations may have changed and you might not have the cash flow for that. So just make sure that your management team or whoever's making decisions on that gets an up-to-date budget and understands where you are. So we've talked a little bit about kind of how to speed cash flow up, how to get payment up front for your customers. We've talked a lot about how to slow it down, how to push cash out. And so now I want to talk a little bit about how to kind of prepare a cash flow forecast. So this is your typical accountant statement of cash flow, right? You've got your cash flow from operations, investing, and financing here. This is what auditors prepare. It's what the banks expect. It's usually part of your monthly financial statement reporting package, and it serves the that aspect well, but it's not a great management tool. I don't like to use this in order to really understand my cash flow. You need to lay out the basics. What's your cash flow coming in and what's your cash flow going out? If you look at this cash flow statement here, and it's just a sample one, I can't see how much did I spend on payroll or rent last month. And so it just is really not useful as far as a management tool. So this is a sample, cash flow management tool that I've created in the past, and I just want to share this with you. Don't worry about the numbers. I'm going to go through and kind of walk you through the framework of this. It's a simple Excel spreadsheet. But let me just point out a couple of things here. So up here at the top, you're going to have your deposits are coming in here. You've got payments going out right here. And then you've got the financing section down here. You've got your beginning cash and you've got your ending cash. And the cash at the end of the day needs to match what's in your bank account. That is your source of truth. So let's do a deeper dive into your cash in. So what are your primary sources of cash here? And for every business, it's going to be different. I encourage you to pick 5 or 6 main sources of cash. That might be a big customer, a couple of big customers that once they make that payment, man, that's a significant cash inflow for you. You might want to tie your cash inflow to your revenue forecast, right? So if you know, and if you can expect based on your historical trend that your customers typically pay you in 30 days or 60 days, you can take your revenue forecast, push it by 30 or 60 days and plop it into your cash inflow forecast. Be careful with your revenue forecasts. They tend to be stretch goals. So I'd encourage you to put a factor on that if you're going to plop it over into your cash flow forecast. Put a 75% factor on it or something like that. Also, if you have deferred revenue, if you do subscription billing for the year and they pay in advance up front, which is great for cash flow, just make sure that you don't pick up your deferred revenue as part of your cash flow, right? You want to know bookings and you want to know once you book it, how long before the customer pays it, and then you can build that into your cash flow forecast. So just make sure you understand the differences there. So now let's take a look at our payments and our cash going out. And I like to put kind of my fixed costs up top because I know that's money that's going out. And I put kind of the variable or stuff that I might be able to push out to 90 days. I put that near the bottom. So, you know, I know my main payroll cost, my main fixed cost is payroll. And that's going to go out, you know, every 2 weeks or twice a month. If I've got a credit card, usually the credit card company comes in and swipes that money right out of your bank account. Your benefits, your sales commissions go in there. And then I have a category here for just fixed vendor checks. So your rent, your utilities, your business insurance, that kind of goes in there. If you want to break it out separately, you can. Again, there's no right or wrong here. There's no black or white. It's just whatever makes sense for your business. What are the primary categories of expenses that you want to track and understand? Down here in variable is where I might put some of my larger vendors. If I've got vendor that's given me an extended payment term and I want to make sure that I match those extended payment terms and get that in there, I want to, you know, lay that out so that I understand what that cash commitment is. Then the financing section here is going to be, you might be getting money in from your bank. You might have set repayment terms to your bank. You might be selling a business line or selling some equipment. You might be getting some investor in or investor funds. And then you've got maybe attorney fees or investment banker fees that go with that. That kind of goes down below. So this two top sections up here are going to be your operating cash flow, and that's going to be how you calculate your burn rate. But these other items down here in financing, it obviously impacts your bank account balance. So you need to understand those and factor those in as well. So some key features for the cash flow management tool that I want to point out here is you've got monthly trends up here, right? So we've got month by month. We've got actual versus forecast. So you can see, you know, January through May is actual, and then July through December is our forecast. The cash down here ties to the bank balance. We've got total deposits and total payments. And the difference between those is your cash burn or your cash flow positive. I set this schedule to auto format. So when it's negative, it highlights it yellow. So it's a model that we can play with. Anything in the forecasting columns, you know, I could come in here with the president or with other members of the management team and say, well, what if this customer paid us sooner? How would that impact our cash flow? What if we delayed this purchase? What if I pushed this vendor off? How does that impact my cash flow? So it's a really, you know, I love playing with it. It's a cool model. It's something that your whole management team should really kind of understand. And it's something that you can also share with your investors as a demonstration of understanding your cash flow and the ins and the outs and how you plan to manage it and how you plan to extend your runway. You know, on this one, we're looking at this, it's actually June is where we are. And you can see in this one, I changed some of the numbers. We run out of money in August. So you've got a 2-month runway. I really should be looking at this daily or weekly. And I did actually have a weekly forecast as well that I was running with this so that we would really understand when were we going to run out of money. So your accountant or your FP&A person should be able to help you with this. It does require some analytical thinking and forecasting. So just make sure they've got that skill set and they're comfortable with the forecasting model. You know, we're happy to help you set this up and then you can run it yourself. I've done this exact same tool for one of my clients here at SC&H. I set it up for them, ran it for a month or two, and then now they're inputting the data and running it themselves. So it's a great tool. It's, you know, I understand what it's like to not be able to sleep at night because you don't know if you have enough to make payroll. It's a scary situation. So being able to lay out the numbers and know the exact time of that helps you a little bit with sleeping at night. So I speak from a lot of experience there. So some cash flow and some final thoughts is cash is king. Just please remember that. Live and breathe that philosophy. I certainly have learned that lesson really well and understand how important that is. Be conservative, you know, make sure that you, nothing's worse than running out of runway, right? Make sure that you've got enough runway and then just make sure you build in some room for the unknown. All right, hopefully you have a couple of takeaways from this part of the webinar. And I would now like to turn it over to Leanna, who is going to walk you through the PPP and the CARES Act and the grant reporting. Thanks.
Well, welcome everyone, and I'm excited about walking you guys through some of this. I know the PPP and CARES Act have been a huge topic of discussion for everyone over the past few months, and I think everyone has been pretty happy to participate in those. If you haven't looked into applying for a PPP, we have great news. It looks like they're going to be extending the deadline for the application. This just in yesterday. So the House has approved the extension for new applications. It will have to go obviously to, or I'm sorry, the Senate has approved it. It's going to be going to the House, and then it'll have to go to Trump, but they're expecting it to be extended for new applications through August 8th. So if you're not familiar with the Paycheck Protection Program, really quick rundown. It's a forgivable loan that the government is offering through the Small Business Administration Program. You apply through your bank, and it's based on 2.5 months of payroll. There's a ton of blogs on our SC&H website about it. If you haven't considered applying before, might be time to think about that. I think the government has definitely demonstrated that they're willing to assist with this cash flow in that Pam has been talking about. And I know all, your customers, everyone is tight on funds, so getting cash from the government could be a really good way of bringing more cash into your companies. So I know everyone has been extremely interested in the forgiveness rules. They have continued to give us new information about that constantly. But if you haven't heard yet, they have extended the 8-week period to a 24-week period. So you now have 24 weeks to spend your PPP loan on allowable expenses, payroll, rent, and those other items that they're allowing. And, a lot of people are asking questions on whether, what's allowable and what's the best way of tracking it. There's several blogs on our SC&H webpage explaining all those things, as well as the SBA website. And then again, even if part of your PPP loan is not forgiven, it's at a 1% interest rate for 5 years. So you can't get a loan from anyone else at that rate. It's a fantastic method of financing. Honestly, inflation will probably surpass 1%. So it's good to consider when you're repaying it as this year ends, 2020 ends. How long do you want to spread out the repayment? And I know everyone will be probably recovering from this pandemic and financial stress from all of this for the next few years. So think about that. I know it's probably a lot of people are thinking, well, it's not that much money. We only owe, $50,000 or $100,000 that wasn't forgiven, but consider whether or not it'll be right for you guys to spread it out over the next 5 years. You want to talk to your bank now. Make sure that you have a payment schedule planned, and when they're expecting you to repay the loan with them. So the loan repayment process will go through your bank, not the SBA. Also, really, really important to keep in mind, especially as the second quarter has just ended. If you're not familiar with the FCRA credits, these are for any employee who is not able to work because they're either sick with coronavirus, or if they're at home taking care of their children because their school or daycare for their children is closed, or if you've been forced to quarantine for whatever reason, whether it's a state or federal rule that everyone has to stay home. And also, a lot of people have asked whether or not you have to do consecutive weeks, or if you have to take a full week. So my husband and I have both been home taking care of our kids, and it doesn't have to be that one of us is using the FFCRA credit and the other is not. You guys, you can divide your time. So again, if you haven't considered this credit, the reporting will be on the 941, which is due in July. And it is meant to be used first before applying the payroll protection, what is it called, PPP. So use the FFCRA credit before using the PPP funds, if that makes sense. This can be used in addition to the PPP and should be used first. What will usually happen is you'll get a refund from the IRS, or in other circumstances, they'll roll the credit forward to future months to apply against your employer tax credit. So this would be for 2 weeks if you're sick with coronavirus, or if any employee is sick with coronavirus, unable to work. There's 2 weeks for that. It's $511 per day. And then if you're also home taking care of your children, there can be an additional 10 weeks, so 400 hours of coverage. It's at $200 per day. And then you definitely want to track this and document why people are, needing to use the FFCRA credit, and whether or not, they were able to telework and all of those kind of rules. So definitely maybe do a little research, read a blog, and make sure. I know there's a lot of information on the Department of Labor website for who is eligible and how to apply, and also check the IRS website and SC&H blogs to see how to apply it and who is eligible. In addition to the FFCRA, there are other tax credit programs. So the employee retention credit is, if you haven't used the PPP, you can apply for this if you've had a 50% reduction in revenue compared to prior quarters, or if you were partially or fully shut down due to the pandemic. So it's a $5,000 credit per employee. It's there's calculation obviously that will be done, but it's up to $5,000 per employee, and you would file this with your quarterly taxes on your 941 that is obviously due in July. This is through the end of 2020 as well. So if you weren't that affected in the second quarter, if you're affected in the third quarter, you would apply then. And again, this employee retention credit is not in addition to the PPP, it's an either or process. Although it is allowable with FFCRA credits, which are separate from the PPP. In addition to those credits, the payroll tax deferral process is allowable with any of the previously mentioned. So if you are using the PPP, you're eligible for the payroll tax deferral. Or if you're using the FFCRA credits, you're still eligible. And what this does is it defers payment of employer taxes. It's not forgiveness, but it does defer them, and will not be due until the end of next year. So 50% at the end of 2021 and 50% at the end of 2022. And this is a no interest loan essentially from the government, which, if you consider that payroll taxes are usually around 7 or 8% per employee on all salaries and wages, this could end up being a pretty considerable amount of money. There is a new line on the 941, as mentioned earlier. It's line 11. But if you haven't spoken with your payroll provider about this yet, definitely speak to them. They should be able to set it up for you and assist you with tracking it for the payroll tax deferral. If you have not already been doing this, if you have inventory and sales and you collect sales tax, this is a really basic one. If you're not remitting it on time by the 20th of the following month, you should definitely begin doing that. They give you a discount. You get to keep a portion of the sales tax that you collected. So, you know, obviously a lot of people, their sales are down, but if you are still making sales and you haven't been taking advantage of the sales tax credit, you definitely want to begin doing that. There's some other tax credits as well. If you have if you perform research and development and you aren't, you know, selling your product, you would be eligible for the research and development tax credit. And this is a credit that you can either apply against income taxes or, and as is the case in a lot of research and development firms, you may wish to apply this to your payroll tax credit. And I know that there are quite a number of other payroll tax credits available right now, but if you haven't applied your R&D tax credit to payroll, you can apply this for years that have already passed. So if you have an R&D credit from 2017, 2018, you can refile your 941s and get that cash. I know we recovered $100,000 earlier this year for a client, so that was a huge you know, cash inflow for them. Just you would want to look at your corporate income tax returns and see if you have a research and development credit that's just sitting there, waiting, you know, for you guys to have net income and owe taxes. So definitely consider that one. Another source of government income is through grants. And there are a ton of grants out there. Definitely check out the SBA website. There's a listing of all different kinds. I know a lot of our clients use the Small Business Innovation Research Credit, so the SBIR credit, as well as the Small Business Technology Transfer Credit, so that's the STTR credit. And these are for businesses who are doing a lot of research, and they will, you know, cover your payroll costs and, you know, literally millions of dollars available in grants there. So if you haven't looked into any grants yet and you think there's, you know, it's possible that you're eligible, there are a ton for women-led businesses, nonprofits. There are quite a few of those. And also, don't forget, when looking at government grants, to check your state as well. So in Maryland, I know yesterday they actually just announced another couple $100 million in grant funding for small businesses and nonprofits. So definitely check your states and make sure that you're not missing out on any state grants that are available to you. I know the Maryland grants that they just made available are like a $10,000 grant for each small business, and that's going to be available on July 20th. So that's brand new as of yesterday. Additionally, I know Pam was speaking about whether or not you may be able to land some investment funding right now. And in Maryland specifically, if you are, you know, doing biotech, which a lot of our clients do, this investment incentive tax credit from Maryland could be the icing on the cake for your investors if they've been hesitant, as I know many have right now. If you're able to qualify as a business, then your investors would be eligible to get this tax credit. So something that may help lure in some of that investment money at this time. And again, this is on the website's listed here, and that application needs to be in by mid-August of this year. So there's a few more months there, but this one is coming right up. So as far as grants, because a lot of people have them right now, this would be a really good time to look into whether or not you're in compliance with your, you know, SBIR or SBTTR grant and remember what the rules are and whether or not you're able to continue drawing down funds as you previously were, and whether there's any interaction between the PPP forgiveness or the FCRA credit and your grants. So generally speaking, double dipping is not acceptable. You want to make sure that if you're funding your payroll with grant funds, that you aren't also trying to get those funds forgiven with your for your PPP loan. It's great that they've extended the period of forgiveness to 24 weeks because it provides a lot more flexibility for grant holders as they continue to draw down their grant funds. They'll have a lot more time to get forgiveness for their PPP loan and spend that cash. So just remember, some grants are expense driven. You have to spend the funds before you can draw down the grant funding. Some are milestone driven. So make sure that you are reviewing those grants and staying in compliance with those. Ideally, the goal is to front load your grant spending and spend the grant sooner than later and get that cash in as quickly as possible. But make sure while you're doing that you are not double dipping or double counting the same expenses for more than one type of government funding. So that's mostly everything that we had to say. I know there was a lot of different information there, but we will be sending these slides out with a ton of links. And I think now I'll turn it over to Pam for some questions. And Pam, you might want to turn your microphone on.
There we go. That helps. So we did get a couple of questions through the webinar. Thanks. I'll try to address those now. Let's see here. So there was a question on, is there a way to benchmark my costs, like how my insurance costs, bank fees, et cetera, compare to best practices? A couple things come to mind. One is we have a lot of clients that are very similar in size and space, and so we can certainly kind of compare and contrast our clients to understand what they're paying. You can also work with an insurance broker to help you understand if what you're paying is really market, and if there's better rates out there. With the banks, you can also just go to multiple banks and get quotes. Takes a little bit of work and effort, but that's certainly an option. There was a question on rent and security deposits, and I just want to point out that if you're actually vacating your rent space, your office space, to make sure that you follow up and get your security deposit. A lot of times landlords will sit on that money and not give it back to you. They're going to hold it for a period of time to make sure that the space was left according to the specifications in the lease agreement. Just make sure that you follow up and push for that security deposit. I think those are all the questions that we got. Again, hopefully you found the seminar helpful and got some tips on how to maximize your cash flow, how to take advantage of some of the PPP and the payroll tax savings that are out there. Colin, I think I'll turn this over to you.
All right, great. Thanks, Pam. Thanks, Leanna. That was outstanding. I just want to remind everyone again to continue visiting schgroup.com, our coronavirus resource center. That's a spot where we're continually updating that as much as we possibly can and as frequently as we possibly can. Leanna already alluded to some of the potential changes to the PPP application deadline. We'll update once that is official. So check out that resource center and please reach out to Pam or Leanna if you have any specific questions as it relates to your business. A reminder, we will email this recorded webinar out by tomorrow morning. So keep an eye on your email. If you have any follow-up questions, just reach out to the team. And thanks a lot for being with us today. We hope everyone continues to stay safe and stay healthy, and have a great Wednesday. Bye.